Just as it came, it went. Earnings season for the S&P 500 is about to wrap up this week. All 500 companies have reported, and today I bring you the facts, where we are, what we're doing, and where we're going with earnings. Now, we can't talk earnings without valuation, so today we're going to look at value, relative value, and where stocks trade with regards to those earnings. And we're ultimately going to answer the question, are we overvalued, and what does that mean for future market returns? We're also going to be looking at the hottest charts and the key macro events this week that'll bring the volatility. And of course, gamma. The gamma squeeze continues, so when will it end? We have a lot to talk about, so let's roll the tape. Hello ladies and gentlemen, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, and like this video. It really helps me with the algorithm. Let's get into it. Now, pretty flat day here in the market. The mega caps, these bigger names, look at Apple, Google, Meta, Amazon, down quite a lot. Nvidia, the only outperformer. Tesla down 7% plus on shipments as well as price cuts. A lot of ugly flows happening there in Tesla, and I think it's going to go lower. A lot of people are hyped on this name. In the very long term, I'm very bullish on it, but I think we're going to see a lot more downside before we see upside here in Tesla. Guys, but it was a fantastic day here in real estate, utilities, basic materials as well. Looking at the sector breakdown, now a couple of things. On my Twitter, I told you what I believe are going to be the best performing sectors for February. I said it was going to be GDX, semiconductors, and real estate. They are the best performing sectors for the month, and generally this is what you want to see. If you are picking a stock or a sector to get into, you really want to see outperformance at the start of the month, because that first 2-week period into OPEX is really when you want to see your stock rallying, because then stocks tend to be flat, somewhat down after the third Friday in a month, and things are really going to get a bit dicey. And the thing with March is that OPEX comes really quickly because the first trading day was a Friday. So after the OPEX, right, we're going to have 2 weeks in the window of weakness. So normally we actually only have 7 trading days in the window of weakness, right? About a week and a half. We're actually going to have 10. Now you might think, oh, it's just 3 more days, but that's actually like 40 to 50% more days in the window of weakness. So you want to see these stocks that you are picking move early in the month, and GDX, XLRE, and semiconductors are probably the place you want to be at the moment. Now, they were the best performing sectors. Utilities was there as well, and you know, the worst performing sectors was services, discretionary, mostly led by Tesla's flows, energy, and software. Other than that, you know, we saw flat days for regionals, technology as a whole, staples, financials. There wasn't much trade happening today. You know, traders were just sitting on their hands. I think they're kind of taking profits in the big boys, waiting on Jerome Powell's testimony on Wednesday, waiting for the jobs report this Friday. I think there's just a lot of uncertainty and people are not doing much in the market, and if anything, just building a bit of cash, expecting some volatility. Now let's hop on the charts. So before we get into it, having a look at actually the major indices and what they produce. The S&P 500 down 0.12%. Nasdaq shed half a percentage point, and again, that was on the bigger names because it is quite concentrated. But then you have a look at the RSP, up 0.18% for the day, and then up another 0.18% in extended hours after hours. Mid caps, the best performer, they hit a new all-time high, by the way. Look at this chart. Remember what I said on my weekend video? Mid caps actually gapped up into all-time highs, had price discovery above, and actually closed at the all-time high level. If we go ahead and look at the weekly chart, you can see here that we closed just above the all-time high here in mid caps. Other than that, it was a pretty flat day across the board. Bitcoin was up 6%. Guys, and the reason why Bitcoin is flying, I think there's just not enough Bitcoin out there. There's a lot of demand with these ETFs right now. Gold up 1.52%, and that's why GDX is up, and I do think that's going to be a trade that's going to continue, and a bit of volatility here in oil. Now let's hop on the S&P 500. Looking at the daily chart, looking at candle structure and location. So traders call this a gravestone doji. It's a red bodied candle as well, and pretty much we gapped down on the open, had price discovery above, and then had made our way all the way down and had some price discovery here at the bottom before bulls did come in a very minor way. If we actually hop onto the 5-minute chart, we can actually see that what we did was we sort of opened, had price discovery here at the lows, and then we sort of made our way all the way up, making higher highs, higher lows, before sort of just like dumping all the way to the lows of the day, pretty much the lows of the day. I couldn't really find any macro news as to why we dumped. So I think a lot of it just had to do with technicals. Maybe sellers came in here at the top along with zero DTE buys and took us all the way to the lows, and we finished red on the day. But actually going back to the daily chart, because really this is what you want to look at, we can see that we're still in this technical uptrend. I said for the most part, the two major levels we're looking at this week as buy the dip opportunities is this 5100 area flat right here. And then if we break, we're going to look at, the 50-60 area. We can go as low as 50-50. These are really the two places where we want to look for buy opportunities. If we look at Jerome Powell's testimony, which I think is going to be a nothing burger, he's going to tell us everything we've already heard before. We do gap down on that news like that, or maybe even the jobs report. If we gap down to any of these levels, but we hold them, that's going to be very constructive. And then you can go ahead and buy the dip. If we do get below these levels on any macro news, that's where it can get a bit dicey. And then we're probably going to make our way to some of these levels right here, closer to 5,000, 49.70, 49.80. But for the most part, we look at this chart right now as it is. We actually did put in an all-time high intraday. It wasn't a close bullish, and we are actually still holding within Friday's top half of the candle, and that's very, very bullish. And you don't want to fight this trend, and you do want to buy pullbacks all the way down, looking for higher price action here, especially if the economic data and earnings come in as good as expected. Before we break down the macro, I do want to bring this to your attention. When we have had a December to February that's greater than 5%, this is what we can actually expect in March. Now, for the most part, we do actually finish positive, up 1.33%. It's just the up years versus the down years. We can see here that by number, we have 21 up years, 9 down years. So in a total of 30 instances, we do get 9 down years. That's about 1 in 3. It's about 30%, sort of around there. So March has a 30% chance of ending lower. That does mean we do have a 66% chance of ending higher. But I do want you guys to understand that we can see a bit of volatility in March, but those red days tend to be pretty small for the most part. And the major outlier here was just a negative 10% in 1980. But if March is kind of red, it's probably going to be flat, and that's to be expected. There is a 30% chance that does happen, especially when we've had a quarter greater than 5%. Now, the weekend poll just wrapped up. Thank you all who voted. The next 100 points in the S&P 500, up or down. 57% of you believe it's up. 43% of you believe it's down. Now, on a week open to a week close basis, this is actually more of a contrarian indicator. Normally, whichever side of the aisle has the largest, we actually finish. The downside has been bigger in recent weeks, and the market subsequently has gone up. So maybe we do get a bit of a pullback this week to catch some of these bulls offside, and that wouldn't be a bad thing, and actually well within history, because the frequency of 5% pullbacks since 1930 is about 3.4. In other words, we get one 5% pullback every 3 to 4 months. We've had 0 this year, and we've had 0 in the last 4 months. So maybe we should expect some form of a pullback. It might not be this week, but definitely in the near term, anywhere from 5 to 10% a pullback, which will just present as a great dip buying opportunity. But if we do get something like that, don't be surprised. It's actually well within the history of the markets. We can also see that as the year progresses, as we go into March and further down the year, volatility does increase in election years. We can see that volatility increases substantially in July, August, September, October, and when we have the election here, I believe it's November 11th. And we can see since 1990 in election years, average monthly volatility starts to increase from about April, May into July, August, September, October, guys. So, that 5% pullback could definitely coincide with increased volatility that we do get in the market during election years. Now, let's actually have a look at earnings. This is blended earnings growth as of March the 1st. 487 companies have reported data as of LSEG, and we could see S&P 500 revenue growth sitting at 3.7%, 9.8% earnings growth, kind of crazy. And if you exclude energy, we're looking at 5.1% in revenue, 13.4% here in earnings. And if Costco, Broadcom, and CrowdStrike produce great earnings this week, we probably are going to go to double-digit earnings growth for Q4 2023. On the 1st of January, this estimate was negative 1.7%. So to see these earnings is actually quite fantastic. At the same time, we're seeing Magnificent 7 earnings growth has outpaced the other 493. As you can see right here, the Magnificent 7 is is the dark blue. The 493 is this light blue. On a quarterly basis, we could see the Magnificent 7 has definitely outpaced the 493, but that is set to change. As you can see right here, from the second quarter of 2024, we're looking at 8% earnings growth for the 493, 8% again in Q3, and then 21% in the fourth quarter. And based on how earnings are going right now, these estimates look like they are going to be hit because earnings is coming in really, really good. We actually just smashed earnings this quarter. Now, guys, one thing I do want to tell you guys is when you get an earnings recession like this right here, when you get negative earnings in the Magnificent 7 or even the 493, it should just be looked as dip buying opportunities simply because earnings typically recover stronger than they fall. When we do get an earnings recession, it's a great dip buying opportunity because if we look 10, 12 months out, earnings recover stronger than they fall and the market actually really rallies on the back of that and always makes new all-time highs. Now let's talk earnings revisions. So normally what happens is analysts will give us an earnings figure, let's say 20%, and then those figures will be revised down all the way to 16%. It's normally how it goes. We get upbeat expectations and then downward revisions. Now the hallmark of a really strong rally is if we get upward revisions, but that's rarely ever the case. As we can see right here though, this is the historical average, this yellow line right here, and normally downward revisions can go anywhere from about 1 percentage point all the way to as far as 10 percentage points. In other words, if earnings was 10% at the end of the year, they're looking at 9%, and that's a 10% downward revision. Now, if we actually have a look at 2024 and 2023 right here, we can actually see that revisions are tracking well ahead of the historical average as well as 2023. We had high expectations in 2023, and then earnings came down in a big way throughout the year. But based on 2024, earnings revisions are actually trending pretty flat. They have come down, but we are starting to see them pick up right here towards the end. And if this does continue, let's say we do follow the trend, go a little bit lower all the way to this level right here, we will actually track earnings well ahead of the historical average and meet those earnings expectations in the 493 and the Magnificent 7. Something else we're seeing that's very weird in earnings season right now is that on earnings calls, there's been a lot of positive development, a lot of positive upbeat sentiment in those calls from executives. We can actually see here that earnings sentiment score is some of the highest it's ever been going back to the year 2004, 2005. But at the same time, guidance is actually coming in a lot weaker. Now, a positive upbeat earnings call with a weaker guide does probably suggest that executives are probably being a bit conservative, and we could see even further earnings beats throughout 2024. Now, let's actually talk about valuation relative to earnings, because at the end of the day, earnings and valuation go hand in hand, and it doesn't matter how much earnings a company produces. If it's already priced in, it's not really worth buying that stock. Now, for the S&P 500, valuations explained 80% of the S&P 500's 10-year returns, and based on the current PE of 25, last 12 months, next 12 months PE is about 20 times. The S&P 500 expected return is about 3% over the next 10 years. So historically, it's probably better to go out and buy a 10-year bond, lock in that 4.2%, and you actually will outperform the S&P 500, at least according to this model right here. Does it always work out like that? Not necessarily, but these are just stats I'm showing you. There are more attractive places to put your money, however. This is the Gotham yield, and it's essentially the returns we can expect of companies that are trading at a deep discount to their relative value. So essentially, we're looking at companies that produce about a free cash flow yield of 9.4%. The stocks in this basket, and I believe it's about 700 to 800 stocks in a diversified portfolio, are at the 11th percentile towards cheap, so very, very cheap. And the average 2-year forward return that you can expect at a 9.4% yield is at 24.67%. Now, I'd love to know what the 10-year returns on this are. It's probably in excess of 10%. But that being said, if you can actually go out to the market and find stocks that are relatively cheap in their sector, you should get outsized returns. That being said, in the last 10 years, growth has outperformed value, so there may be an opportunity cost there, but it's never a bad thing to go ahead and buy undervalued stocks, especially if it's a great company. Having a margin of safety against your purchase price will allow you to weather storms such as recessions or volatile periods in the market. At the same time, looking at the Russell 2000, which we could say is pretty much value stocks for the most part, the absolute forward PE for the Russell 2000 suggests double-digit annualized 10-year returns. Based on where the PE is right now of about 14.72, we can assume that the Russell is going to have about 10 to 11% earnings growth over the next 10 years. And that's absolutely fantastic returns. And it's not going to be that linear. It might be 15% one year, 7% the next year, 2% the year after that, 40% the year after that. But on an annualized basis, you're looking at double-digit returns in the Russell 2000. But the Russell 2000 probably isn't the best index. I would actually have a look at small cap quality. You know, the forward PE of the Russell is 14.72%. Most small cap quality ETFs are trading at about 15.5, and you just have such higher quality company names. So, or look at the S&P 600. That's another good one right there. Now, is the Magnificent Seven overvalued? Well, according to this valuation model right here by Goldman Sachs, now do take this into consideration. This is as of February 1st. The Magnificent Seven are fairly valued, and you can see this line of best fit right here. Long story short, if it's in line, it's fairly valued. If it's above, it's overvalued. If it's slightly under, it's undervalued. You could say that the S&P 500 and the Magnificent Seven are probably fairly valued right now. And this is simply based on the actual PE versus the modeled PE and what earnings are expected to look like against their price. Do take it with a grain of salt. This data is 1 month old, but I would say these metrics are around the same. Maybe the S&P 500 has gotten a little bit more expensive and the Magnificent Seven have gotten slightly cheap just because of the underperformance in Apple, Google, Tesla. But that being said, the data is there right in front of you. Let's talk gamma. Now, looking at seasonality, guys, this is my March composite cycle, and this is essentially when we have January, December, and February all positive. What can we expect in March? And normally we can expect returns just under 1% and pretty linear returns. We do get quite the boost up at the start of the month. That's exactly what we've seen so far. The 1st of March on Friday's trade was very, very positive. So we are starting along the seasonal trend. From there, we should see a little bit of volatility here in the first week towards OPEX week, but that all should be parred as we go ahead and make higher lows, higher highs into the end of March, into April. Now, looking at the risk off, risk on indicator, we're sitting at all-time highs. Now, risk on essentially is copper, high yield bonds, Aussie dollar, semiconductors, and high beta stocks versus gold, US treasuries, the yen, utilities, and staples. And essentially what this indicator is telling us is that it's risk on. We've been in this neutral zone for the better part of 18 to 24 months. We've broken above this line right here, and sentiment right now is risk on. And I would say that until we break this level right here, it will continue to be a risk on trade. Even if we do come down, risk off may outperform, and we are starting to see that in stuff like gold, but we will need to see follow through in all the other risk off indicators. I'll keep you guys updated with this. For the most part, guys, it is risk on right now, and it is a good time to buy risk on assets, especially with where earnings are trending at the moment. Looking at a bunch of other indicators, high beta versus low volatility against the S&P 500, and you can see here that high beta definitely outperforming low volatility. At the same time, cyclicals is outperforming defensive, and discretionary is outperforming staples. These are all risk on signals right here, and you can see this gray line very faintly, the S&P 500. The S&P 500, for the most part, has gone along with that. The S&P 500 is a risk on trade. You can see here that the US dollar has gone down. That's actually bullish as a whole for the S&P 500. A weaker dollar does improve international corporate earnings. The S&P 500 advanced decline line continues to make new all-time highs, and I posted this on Twitter. This is actually slightly outdated, maybe by a day or two. We are now at new all-time highs in the S&P 500 advanced decline line. And then high yield bonds versus treasury bonds, we can see that we are starting to pull back here in high yield, but for the most part the trend is up, and high yield bonds are favored over treasury bonds at the moment. Again, all of these signals, guys, are risk on, and that means any opportunities where we do dip in the S&P 500 or your preferred asset, by the dip, sentiment is risk on. Now, looking at the sentiment composite, this indicator just consists of the AA sentiment survey, the bull bear spread, the NAM exposure index, the VIX, put call ratio, 5-day and 10-day, and we can see here that we're getting very close to this risk situation right here, and that's because there's a ton of euphoria in the market. When everyone's pessimistic, that presents opportunity. Now, just because we are at this risk zone doesn't mean we're going to absolutely dump right here. You could actually see that when we did get into this risk zone and then moved into the opportunity section, we actually went on quite the rally, and this is like 30-40% in the S&P 500 in mid to late 2021. So sentiment getting a bit frothy, but it normally does in bull markets, and it can continue for quite a while. Now, looking at percentage of stocks at 52-week highs versus 52-week lows right here, and you could also see the 52-week high level moving up all the time, and the 52-week low level probably going to be at here for a while before it does shift up when we get to these levels. But we're constantly making new highs here in the S&P 500, and at the same time, stocks making new 52-week highs kind of are in this uptrend, as you can see right there, and hopefully that does continue. But you could also see here that stocks at 52-week lows, sure, you could say they're increasing a little bit, but virtually inconsequential for the most part. You really want to see a drawdown, you want to see stuff like this, and until we actually get that type of price action, this right here, the market's simply not going to pull back to any significant level. Sure, we can get a pullback in the medium term, but likely met by bullish demand. Looking at the Magnificent Seven, this is the equal weight index, guys, and this is what's incredible. This hit all-time highs despite Apple, Alphabet, and Tesla not really performing. Now, Alphabet is not really moving to the downside. Tesla is down about 30% from its highs. Google is kind of just moving sideways. The market is trying to price in what it's going to do. Is it falling behind in AI? What's going on? Is it losing market share? It's no more a disruptor. It's been disrupted. Apple, the market just wants to see earnings, but it's such a big company, $400-500 billion in revenue. Really hard to grow at that size. And then what's really holding this index up here is Nvidia, Meta, Amazon, Microsoft. That being said, the Magnificent Seven at all-time highs, but the Fantastic Four, excluding Apple, Alphabet, Tesla, would probably be at even higher highs. Nonetheless, the leaders in the market in the last 2 years are making all-time highs. That is bullish. Now, guys, looking at data this week, the focus will be on the employment report and ISM services. Now, breaking it down just more specifically, let's actually have a look at non-farms, what we can expect. So change in non-farm payrolls, the consensus is 193K. BOFA's estimate is 215K. Private payrolls, 185 is BOFA's estimate. The consensus is 150K, and we are expecting the unemployment rate at 3.7%. Average hourly earnings, this is a big one, by the way, 0.3%. If we do get a hotter number than that, that could stoke inflation fears. A cooler number might actually not hurt. And then weekly average hours, we really want to see what these are. We also want to have a look at the revisions. What are the previous announced numbers tracking at versus what the numbers have been revised to? And then we also want to have a look at the labor force participation rate. Previously 62.5%. BOFA's estimate is 62.6%. But if you've made it up until here, guys, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, guys. Like this video and leave a comment. It really helps me with the algorithm. Cheers.